Welcome, everybody. Glad to have you here to talk about some pretty important topics. Definitely important enough that people talk about it a lot on the news, and people talk about it in politics, and frankly, these things, the dollar, trade, and commodities, truly impact you and your lives. We'll be going through all that today. First, a couple housekeeping items. One is this is being recorded. The session's hour and 10 minutes. I'll probably talk, for about an hour. I'll take Q&A at the end. I have some questions that were already sent in ahead of time. Before I get started, just a little bit about myself. So I'm a professor of practice, and I direct the investment program at University of Wisconsin-Milwaukee. I also help out IE Business School as a periodic adjunct professor. Before I got into teaching, my career spans about 30 years. Been teaching around 20 years, 25 years, but I've also been doing investments for over 30. I was an analyst, a portfolio manager, director of research. I managed a team of analysts. I managed money in both for a large pension plan and then also mutual fund money. And ever since I've joined academia, I've been doing something, research, advisory work, something like that for investments. So I'm very much involved as a teacher, and I'm also very much involved as a practitioner. So you can call me a pracademic, and that's, I don't know if it's a true word that you will look up in the dictionary, but it is in Wikipedia. So I'm a professional who happens to be teaching. So today, our outline, we're going to be talking about the dollar, what drives it, why is this important? You can see over on the right, the dollar has been rising over time. Some people in politics don't like that because supposedly this dollar rising makes our exports less competitive. We'll be talking about trade, and you can see this right here is our trade deficit. All these are negative numbers, so which means the trade deficit is negative. It's not as negative as it was back here, but it's still 3% of GDP or so negative. So we'll be talking about the trade deficit and kind of what causes it. And I'll give you a solution right here to fix it, but you're probably not going to like that solution. So stay tuned for that. Now, the dollar is definitely related to commodity prices. We'll walk through what drives oil prices. And frankly, why should you care about this? Because it's very correlated with inflation, which I'm guessing you care about. And inflation, by the way, is also correlated with interest rates, which I'm guessing you care about. Now, over the last 15 years or so, this is Goldman Sachs Commodity Index, commodities have gone up and down, but, kind of averages since 2006, where we're at right now. This was the big spike during the inflation, following the COVID and the opening up of the economy. So let's start out with the dollar, okay? And I'll weave in what's happening with trade later on in our discussion of the dollar. So first of all, I would say the dollar is popular, meaning the value is going up. Also, it's very popular in the press. So this is actually just Google search trends for the dollar. And you can see since 2012, there's more and more interest in the dollar, and it really spiked here. And when the dollar was spiking higher, following with basically the opening up the economy after COVID. Now, the dollar is really important for world economies because much of the world's reserves, transaction volume, debt issuance, so other countries issuing debt in dollars, currency and banking claims and liabilities are in dollars. If you look at this, where the dollar is the blue, it's about 60%. And that's been relatively stable over time. Some people may not like having the dollar as the reserve currency, but we can talk about it in the Q&A. What is the better choice? Is it crypto? What is it? I had a question that was written in on that one. So we'll talk about that in the Q&A. So why is this dollar being so popular, 60% of these different transactions, debt issuance, et cetera? Why is that costly to the U.S.? Well, If the dollar is a reserve currency, it could become overvalued. And it makes imports for us cheaper because a lot of the trade is done in dollars. If our dollar rises 10%, then everything overseas basically became 10% less for the people sitting in the United States. And by the way, our exports became 10% more expensive to everybody overseas that may be buying it. So that's the main cost to the US. Now, what is the benefits to the US of the dollar basically being the reserve currency? Well, we can issue debt in our own currency. If you issue debt in the dollar and you're in another country and the dollar rises 10% and you have like a 5% interest rate, the dollar goes up 10%, but all your tax revenues, everything else is collected in your currency. That 5% interest rate, just went up to more like 15%. So that's difficult. And why do other countries issue their debt in the dollar? Because it's more stable than their currencies. So they choose ours. So the fact that our currency is stable and considered safe, we can issue debt in our own currency and we don't suffer what others may suffer if they're issuing their debt in dollars. That also gives us influence on the world, assuming you like that. And if the dollar is considered safe, that makes the US considered safe. That lowers the cost of capital, interest rates, the cost of capital for projects for firms. If we have a lower cost of capital, you have more projects that make sense. If you have more projects that make sense, you grow quicker, you hire more. It's basically prosperity. So, if we don't like this dollar going up in the reserve status, you got to think about we may lose some of these benefits. So it's not such an easy solution. Okay. Now, to prove to you that the dollar is considered a safe asset, what I've done here is I've correlated in blue the change in the dollar up and down in the blue with the returns of the U.S. government bonds, which is considered a safe asset, to S&P 500 stocks, which are considered more risky. Stocks are more risky than generally government bonds. And what you see is when the dollar goes up, okay, if it's safe, that's when people are getting rid of stocks and buying government bonds. So they kind of go up and down together. Now, recently is the world moving on to risk on, given the recent decline in the dollar? So this blue line, it was rising. This is an annual change in basis. Now it's actually falling on an annual change. So if the dollar is falling, does that mean the world is moving on to a risk-on environment where maybe the economies are accelerating around the world, or is something else causing this? Possibly politics. We can talk about that a little later too. So what is the dollar driven by? This is the rising dollar over time, again in the blue. The annual change is in the black. Down here, I basically put 5 things that influence the dollar. Probably the most important thing is the one I do first. Basically, the relative economic growth of the US relative to the world has a great influence on the dollar. So if the US is strong versus the world, right, the dollar is going to be doing well, right? So again, if you want a weaker dollar, I'm kind of going ahead to my last slide on this. If you want a weaker dollar, you're basically saying I may want a weaker economy. Do you really want a weaker economy? So we'll get to that a little later again. So let's prove the first point. So economic growth, if US economic growth is good relative to the world, the dollar should be doing well. So what I have on the left, well, I have a bunch of charts here. And so if world earnings are falling, the dollar should be rising, okay? It's because when world earnings are falling, the US is not falling as much. So what I have on the top left is the change in the dollar, the black line, on an annual basis, and the earnings of the S&P 500. So, they kind of go up and down together. Maybe there's some leads and lags here. Now, on the bottom, I do the same thing, but I do world economic growth in the blue and the dollar. You're starting to see a little bit of inverse relationship. But if I take the top chart and earnings, the blue on the top chart, and I subtract the blue on the bottom chart, I get this black line. Whoops, sorry about that. I get the black line. So when world earnings growth is going higher, the US earnings growth is not doing as well. And when world earnings growth, the blue, is coming down, the US does relatively well, meaning it probably doesn't go down as much, okay? So it turns out the US relative earnings growth runs inverse to the world's earnings growth, which includes the US, but again, there's a lot else that's not the US. So if I look at the black line on the top, which is the US's earnings growth of the large companies in the US, S&P 500, I move that down to the bottom chart. So this is relative earnings growth of the US, and I look at the dollar, it kind of moves up and down with US relative earnings growth. So this is telling you, if the US's earnings are doing relatively well, the black line in the bottom right chart is going up, we're more attractive to the world as an investment. If we're more attractive to the world as an investment, guess what? There could be flows from overseas into the US. And if they want to buy these US stocks that have this relatively good earnings growth, guess what's going to happen to the dollar? Well, they got to convert their currencies to the dollar to buy our stocks. So they're going to be selling their currency and buying the dollar, pushing up the dollar when our relative earnings growth is good. All right. Now, what this is saying right now, the dollar is relatively weak, right? This probably means the US earnings growth is going to be slowing relative to the world, and maybe the world earnings growth up here is going to be picking up, okay? All right, so instead of looking at earnings, let's look at the overall economy and just prove out this main driver of the dollar a little bit more detail. What I have on the top left is the world's GDP growth, an annual change going back to 1984, and that's in blue. And then I have the US's GDP growth in black. What you can see is the ups and downs of the blue, the world, is much more volatile than the US. So the US is much more stable. And if the US is more stable, it's less risky. So when the world's falling apart, GDP, people will probably rotate to the US because it's considered a safe haven. Right, so the bottom left graph just looks at world nominal GDP growth and the dollar inverted. So the black line is inverted. So when the world's GDP growth goes up, let's say here in 2009, so the world's GDP growth is going up, and since the dollar is inverted, that means the dollar, which is the black line, was going down, okay? So the dollar rises when US GDP accelerates relative to the world. This is kind of like what I did on my earnings relative chart on the last slide. I'm just looking at US relative GDP growth and the dollar. So when the US is relatively good, has high GDP growth relative to the world, the dollar rises. And we like that. If you're sitting here in the US, us have good relative GDP growth. So if you like that, well, maybe a negative outcome of that is you're going to have a higher dollar, okay? Right, so the next thing that's really important to driving a dollar is inflation. Now, I'm not going to go through all this math here for you, okay? I'm going to be sending these slides to you afterwards so you can look at this on your own. But let's just think about how inflation drives the dollar. So the US has relatively low inflation versus other countries, our dollar will rise. Now, think about that. If our inflation is lower in the US, then our price of our hamburger will go up less than other countries each year. So if our price of our hamburger goes up less than other countries each year, then our relative purchasing power of each dollar, how much hamburger can buy, improves relative to other countries each year. So US relative inflation, if our inflation rate is lower relative to the other countries around the world, since it's a negative relationship, our dollar rises. And that's what you can see in this chart. So this is US versus Europe inflation. When US inflation is going up versus Europe, basically the number of euros each dollar can buy is going down. So that means the dollar is depreciating. Now look what's happening here recently. The euro's been strong relative to the dollar, or you know, this black line says the dollar can buy fewer euros. So the, you know, basically the US dollar has become less valuable relative to Europe. Now, what does that mean? Well, since it's inverse relationship, does that mean the market expects higher inflation in the US? That's what it would suggest based on historical relationship, if inflation is the only thing that matters to the dollar. Or could it be that European growth is going to pick up, hopefully post the Ukraine conflict, or because of maybe Germany doing a whole bunch of stimulus? Or does it mean people are a little bit concerned about the US as basically a reserve currency? And reasons why they would be concerned about that is rising government debt, possibly loss of Fed independence. And if you lose Fed independence, if you look at history where the Fed central banks weren't independent from their central governments, you generally had a high bout of inflation. And because most presidents, no matter what party it is, if the Fed's not independent and they control the Fed, they're always going to want to have lower interest rates because you're always going to want to have a strong economy. But unfortunately, strong economies come up with high inflation, which would make the dollar go down. Okay. Moving on. Next factor is interest rates. If you think about, if we have good earnings growth relative to the rest of the world, our stocks are, basically attractive versus the world. So people will move money here. That pushes up the dollar. Well, if we have higher interest rates relative to the world, then our investments in bonds also becomes more attractive to the rest of the world, which will drive up the value of the dollar. So what I'm showing you in blue is just the US 5-year interest rate versus European 5-year interest rate and the annual change, the year-to-year change. And what you can kind of see is when the blue's going up, what happens, so our interest rates are higher, all right? So how many euros do we get for each dollar? Well, the black goes up, okay? So that if we're getting more euros per dollar, that means the dollar can buy more euros. The dollar is strengthening in that particular case. And that tends to happen when interest rates are higher. Now, of course, that tends to happen when interest rates are higher because inflation is higher because the economy is stronger. So the interest rates are kind of an output of the first two factors, inflation and GDP growth too. But this is just looking at it, one at a time. Now, the next factor is exports. And I kind of say the impact on the dollar is this question mark, because you've seen it basically having influences both positively and negatively on dollar. I'm just going to read this to you, and then you can kind of look at this, in detail later on. So this is not the one I tend to focus on when I'm thinking about what's happening in dollar. So a lower dollar means the world economy is strong. I've showed you that. And that should reduce the trade deficit, okay? When world economy is strong, hey, they can buy more of our stuff. So if they can buy more of our stuff, and the world economy tends to strengthen more than the US because the US is more stable. So yes, they can buy more of our stuff and even more than the extra stuff we can buy from them. That should reduce our trade deficit. So lower dollar means the world economy is strong, reduces trade deficits. A lower dollar makes our imports more expensive and exports less expensive, okay? So if our dollar goes down 10% and everybody buys our stuff in dollars, then they just got a 10% discount on things, what we'd be exporting to them. But if the dollar goes down 10%, then the cost of everything we import just went up 10%. So that would be a lower dollar should reduce the trade deficit. However, what if the trade deficit, if the trade deficit is improving, that probably means foreigners are buying relatively more of the U.S. goods and services. And, since trade is exchanged in dollars, so if they're buying more of the U.S.'s stuff, you got to get dollars in order to buy the U.S. goods and services. That should make the dollar rise. Which one happens first? Up to you to decide. All right, now let's move on and start talking about trade. Part of the reason I showed you earlier that the U.S. is less cyclical, less up and down, the black line is way more stable than the blue line in the top left chart. Part of the reason why that's the case is because trade is very cyclical, okay? So if we look at world GDP growth on the top left chart and we look at world exports, they go up and down together. And exports go up and down more because if you look at the scale on the right axis, this scale is a wider scale than the GDP scale on the left. And the same thing happens to imports. So when world GDP is going up, imports go up, exports go up. And the world, though, trades way more with each other. So imports and exports combined are about 60% versus the US. US is much more self-sufficient. We're a large country. We stretch from ocean to ocean. We have all kinds of natural resources. We have, as many people as Europe. So we don't need to trade as much with others. So if trade is very much up and down and we're not trading as much with each other, then, the US is going to be less cyclical since trade is part of GDP. Now you see this little blip up right here? And that's imports as a percent of GDP. That's basically, when everybody got excited about tariffs earlier this year, everybody, companies that imported things, they ran out and imported a whole bunch to get ahead of the tariffs. And now that's started to come down. But you can see this gap here between imports and exports generally has risen since the 1990s. And that's what people are kind of worried about. And at least some politicians are very worried about that. That this looks unfavorable to the US because we're importing more than we export. And if that trade balance is negative, that takes away from GDP. Okay, let's talk about what we trade and why even our trade deficit is cyclical. We tend to trade more what's called durable goods. A durable good would be like a washing machine, a car. Well, unless your washing machine and your car break down, that's a want, okay? It's not a need. And so the things that we trade, it tends to be a little bit more goods than goods, which are wants than needs. And looking at the US just very specifically, if we look at all of our imports, this is top right chart, durable goods are a large portion of what we import. Services are less of what we import. Services would be like insurance plan, healthcare, all right? So those type of things. Now, if you look at what we export more services and we export less goods. So the US, if you look at our trade balance, we export fewer wants, but we import more wants. So when times are good, okay, when times are good, if you're importing more wants and you're exporting more of this very stable services or needs, when times are good, your trade deficit's going to get worse in the US. Um, here's an example of this. Fuel, fuel for car, oil. If you look at the exports of fuel around the world and you look at the annual change, it tends to be somewhat correlated with the blue line, which is GDP growth. So of course you need fuel at all times, right? You need fuel to maybe heat your homes, you need fuel to get to work and stuff like that. But you'll use more fuel. You'll in the summers, you'll keep your home cooler, and in the winters, you'll keep your home warmer, and you'll use more fuels when times are good, and the economy is good. And when the economy is bad, you're going to, basically turn down your electricity in the summer and turn down your heat in the winter. And also, when times are good, you may go on a vacation. So you're going to drive the car and you're going to use more fuel. So part of the reason why, again, trade is cyclical is just because part of the trade is this fuel, which is cyclical. Okay. Let's talk about tariffs. So a little bit of history lesson, first of all, before we talk about the current tariffs. Tariffs are generally way back in the 1800s, top left chart. Tariffs were, 40%, 30%, 20%, 50%. Okay. Now back here, the economy was probably much more enclosed, much less reliant on foreigners. Okay. Because we had such high tariffs. Also, we had way more recessions back here. Okay. Now, since basically the 1910s or so, tariffs have come down until real recently. Now, August 30th, the tariff rate was 18.61%. Now, that's not exactly right. We'll get to that in a second. But before I get to that, what's happened when tariff rates went down? So tariff rates going down, people trade more. You have to think to yourself, is that trading more benefiting you or not? Okay. But definitely lower tariffs means people trade more. Okay. But world trade kind of peaked out about 10 years ago, just for reference point. All right. Now, the tariff rate in August was 18.61%. It's not the actual rate that we're experiencing. Okay. We're experiencing around 12%. Okay. Now, why is that? Because maybe our trade deficit with China has gone down, but maybe China is rerouting some of its trade through other places to get to the U.S. We also have the U.S.-Mexico-Canada agreement. Maybe there's more adherence to that, which, basically, since the tariffs went up for our other countries, maybe they're trying to adhere more to that agreement, which can bring tariff rates down. Also, there's a lot of exceptions. We have this AI boom in the U.S., and there's been some exceptions on imports of things that are necessary to fuel that AI boom. So ultimately, this is about 12%. Now, how does that affect you and me? Well, go back here. Remember, we import, around 14% of our GDP. And so if we have a tariff of 12% on 14%, well, 12 of 14, that probably means that the average price of things should go up 1.5%. It's actually a pretty big tax, because 1.5% on an economy that's almost 30 trillion, that's like a $600 billion, extra tax bill. So it's sizable. Right now, that's assuming all that is passed along to consumers. Some of it may be eaten by the ones that are selling us their goods. Corporations may also just eat the cost and not pass it along to consumers and higher prices, and that would mean the profits for the companies will go down. But it's a sizable number, and really what we're getting back to is a number that takes us back to maybe the 1940s. Now, will that tariff stick? Okay. So this comes from the Tax Foundation, and this is a recent publication. The tariff rate's 15.8%, okay? So this was August, they calculated as 15.8%. The tariffs, some of them were executed or put into place through this powers, IEPPA. If the Supreme Court strikes that down, this 15.8% will fall to 6.8. Not quite as bad. Right now, this is costing $1,100 per household, expected to go up a little bit in 2016. So if you think about the average household makes, maybe 80-some thousand a year, 1,100 is not a small piece. I mean, GDP growth, real GDP growth rises, 2-3% a year, and that, for consumers, that just took out maybe half of their basically ability to improve their standard of living each year. Okay. Now 15.8 to 6.8, but remember, consumers may not want to buy those things that are more costly. So the actual, what they estimate that it's costing people right now is around 11.2, and if the Supreme Court strikes some of these tariffs down, they'll go to 4.6. If the Supreme Court strikes the tariffs down, it's highly likely, based on what I've read, and I'm not an expert on this, so I'm kind of relying on other experts, that the administration will find other ways, other rules to increase the tariffs. But temporarily, it could fall. And by the way, well, just so you know, if it is ruled unlawful, you have to give the money that you collected already back to people. And if you have to give the money you collected in tariffs back, does that result in extra spending, which then will pump up inflation again? Or will inflation come down because the tariff rates are lower? This is a very interesting time we live in. I got a couple questions on the next 2 slides for you, and these are really thinkers that I think you can talk to your family about and others. The question on the top is, who sells more to the other? Does China sell more to the US, or does the US sell more to China? Now, most people would say, well, the trade balance, US-China trade balance, got to be 400 billion. So that means we're buying 400 billion more goods and services from China than they were selling to us. And it's improved here since 2017, the trade war. Now, it's improved, assuming that China is not rerouting this through other countries. So when you look at this balance, I think the administrator said, this is easy to win. This is going to be more painful for the ones, where we have a trade deficit with. If we do tariffs, if we do 20% tariff on them and they do 20% tariff on us, they'll lose more because they sell more to us than we sell to them. Well, this goes back to the question, who sells more to the other? It turns out the US sells more to China than China sells to us. So this goes back to something I looked up back on 2017 and 15. This comes from the Congressional Budget Office, and I also read China's response to our tariffs back 8 years ago or so. So the deficit at that time was, well, U.S. imports 506 billion and our exports were 130. That was in 17, or 483 versus 116 and 15. So basically, we had about a $400 billion trade deficit. That's what we're talking about here, around 400 billion. But the trade deficit doesn't consider the fact that U.S. companies in China, manufacturing in China, and selling to Chinese, sell 481 billion. Well, the Chinese companies with manufacturing operations in U.S. selling to us only sell 26 billion. If you include the U.S. affiliates operating in China selling to them, and you add, here we have a huge trade surplus, and you add this to the trade balance here, what you find out is we have a net trade surplus, all things considered, We actually sell more to China than they sell to us. And some of our most valuable companies are reliant on China for the supply chain. I think the reason why this trade war has been so hard to resolve is simply that China has lots of opportunity to pressure the US because so many of our companies are operating in China. And, recently they've been exercising, kind of the rare earth threat. That's very important to some of our technology. Okay, another question for you, just to think about. Does trade lead to more prosperity? Well, if we trade more, you would think that we have more mutual economic benefit and there would be increased cost of conflict. So some people say, we want to trade more with everybody else because we'll have fewer wars. Well, that's out the wars. Now, other people will say, well, if one country is more dependent on trade than the other country, we have an imbalance. If two countries have some competition over resources like rare earths, there's going to be more conflicts. So some people say more trade results in more conflicts. Some people say it results in less conflicts. I'll leave that one for you to think about. Second is, does trade lead to more prosperity or less? Well, manufacturing jobs, goods jobs, as a percent of non-farm payrolls, I mean, it used to be back in 1990, it was, over 20%. Now we're down to, looks like around 13%. So that means a lot of people lost their job as we outsource. But as we outsourced, the inflation rate, the blue line in the bottom chart, has come down as the amount of trade has come up. So yes, the ones manufacturing the goods have lost jobs, but maybe everybody else has benefited from lower inflation, which means we can buy more units of things, and that can lead to prosperity. Now, how do we solve this trade deficit? I told you I was working up to this one. Well, a solution to it, you're not going to like it, is make the US weaker. Nominal GDP growth, so GDP growth in the US, and I invert the trade balance. So when US GDP growth, the blue line's going down, that's a recession, the great financial crisis. Guess what happened to our trade balance? It actually got better. Okay, so the black line was going up, which means we had a better trade balance. Coming out of COVID, GDP flew, and what happened to our trade balance? We buy more goods than once. The trade balance got worse. It went down 1%. Now, this little blip up here, again, is our trade balance worsening earlier this year as people were trying to get ahead of tariffs. The last factor that I'll just leave you with that's driving the dollar is fiscal policy. Now, this one's also a little bit more complex, but if our fiscal policy, our government budget situation gets worse, that's the blue line going down, that makes the dollar go up. Now, why would that be the case? And by the way, when it got better, dollar went down and vice versa. It's not really the greatest relationship. Remember, I said economic growth is number one, and probably inflation and interest rates are number two, and tied for number two, what drives the dollar. Now, why is that the case? So if our budget situation is getting worse, that will spur on economic growth in the US. And if we have more economic growth, that'll make the US more attractive for foreign investments. And if they invest in the US, they can convert their currency to dollars. In order to do that, that pushes up the dollar. Now, more debt could also push up interest rates. And remember, interest rates are positively related to the dollar. If the foreigners fund part of the government's spending binge, then they have to lend to us. They have to buy treasuries, and to do so, they must buy them in dollars, which pushes up the dollar. Now, I have a big old however. What if our debt situation of the government is so high that people start abandoning the dollar as a reserve currency, and they no longer consider the U.S. a safe haven. If that happens, the dollar would decline. And what if this additional spending from the government increases inflation? And we've said inflation has this negative relationship with the dollar. Putting it all together, I have a model of all these 5 things. And what the model is saying right now, that's the index, the blue line. And you see the blue line is highly correlated with the exchange rate of the dollar versus the euro. The blue line says the dollar should be starting to perk up, should be rising. We should be getting more euros per dollar, but it's going down. So what in the world's happening here that the dollar is depreciating when the model, which is all these factors together, said, hey, you know what, it should be improving a little bit here recently. That's where, you know, maybe the Fed independence and some other the other concerns about world reserve currency maybe having an impact. Okay. Now, I also like to look at when I'm forecasting or thinking about where the dollar is going to go, how are investors positioned, because they can drive this. So the blue line is just the number of traders in the futures markets that are betting that the dollar is going to go up. And you see they're betting the dollar is going to go down right now. Okay. Now, and it's really low. Now, if you look at where the blue is versus here, it's pretty extreme low. So the investors are very negative on the dollar. Okay. Now, they tend to be the most negative on the dollar when the dollar is weakest. And my model says it's going to go up. I use them as a contrary indicator because when they're the most negative, it's normally right around the time that the dollar is going to start appreciating. So yeah, I kind of use them as a contrary indicator. So that would mean to me that all the traders are thinking the dollar is going to go down, or already pushed it down, and they're positioned that way. So who else is going to push it down? And it may be a time for a rebound. At least that's what the model's saying. And there's a bunch of different things that impact this. Right, so the last thing I want to do, I just have a few slides on this, is just talk about commodities. And we're going to end up, and I'll bring out the dollar and trade again. We'll talk about why you should care. Now, a lot of people say, hey, oil prices, I'm just going to look at oil prices as part of the commodities. When demand's higher, oil prices should go up. And that's what you're seeing here. This is world industrial production, basically output of utilities and, you know, basically manufacturing. So when the world output's higher, so the black line's going up, oil prices, West Texas Intermediate, tend to go up. On the top line, I show the ISM PMI index. It's just a survey of manufacturers. If that black line is going up, that manufacturers say, hey, the business is growing. If the black line is going down and it's below 50, if it's below 50, that means businesses are shrinking. And you can see when the black line goes up, business is increasing, it's growing, oil prices go up. So that makes sense. And a lot of people say, well, when demand's high, economy is strong, oil prices go up. That is not the whole story. And a lot of people fail on this because they miss the second factor. Don't forget supply. Oil prices and basically our rig count, how much we're drilling for oil, are highly correlated. So when the blue line goes up, oil prices go up. Notice that companies say, hey, oil prices are higher. They're probably going to stay higher. So let's go actually have a whole bunch more rigs. Of course, if they make the rigs go up 100% when oil prices go up, you're going to have, and everybody's doing this, drilling more, you're going to have too much supply for the demand, and of course, oil prices are going to plummet. It turns out a big reason why oil prices are so volatile just because the U.S. and drillers around the world basically drill more when oil prices are high, drill less when oil prices are low, which reduces supply, which increases prices. If they would just drill the same amount every year, you wouldn't have such volatility in oil. And it's very important because it impacts inflation. So what I've done on the bottom left chart, I look at oil prices again, and I look at the inventories of oil. Now, this is just US inventories. It'd be better if I did this with world inventories. But, and I inverted inventories. So when inventories are rising, the black line is the right axis. So when the black line is going down, that means inventories are rising. Well, of course, I have a lot of inventory. I'm going to have to sell my oil prices for less. Now, where is it right now? Inventories are kind of flattish to rising a little bit, and flattish to actually starting to get to zero and going down. That would probably mean that oil prices are about the bottom and start to go up. And by the way, that wouldn't be good for inflation, and it wouldn't be good for the dollar. So the dollar, talking about the dollar, this is just the annual change in the dollar, the top right graph, okay? And oil prices move opposite. Just take a look at that graph just for a second. Every time the black goes up, so the dollar is strong, oil prices go down. Now, why is this the case? Well, remember, when the dollar is strong, I told you the economy is normally weak. If the economy is weak, you're going to have less demand for oil, and oil prices go down. Now, the oil is priced in dollars around the world. So if the dollar rises, let's say 15%, then people in other countries who are thinking about buying oil, the price of oil just got 15% higher for them. And if oil just got 15% higher for them because the dollar went up 15%, they're going to buy less oil. And if they buy less oil, demand goes down. What happens to prices? Prices go down. So oil and the dollar kind of move inversely. And by the way, that's really bad because both oil and the dollar impact inflation. And they impact inflation opposite. Now, recently, the trade wire dollar is going down and oil is not perking up. Normally, oil would be going up in that particular case, because if the dollar is going down, that probably means the world economies are strengthening, and you would think oil would be going up. So maybe oil is about to go up, or it could be there's some other factor that's driving this dollar weakness. Also, like I wanted to do, and for the dollar, I want to look at what the speculators are doing for oil, because you have people investing in oil stocks and oil futures. And what you see on the top right is when oil is going up, which is the blue line, when oil is going up, the traders in oil are more bullish. They put on more long positions, but they do that in a 12-month delay. So oil prices are high, and then oil prices high. Oh, I guess I could think they're going to continue to be high, which normally they're not. So all these speculators go up, buy up oil futures. Okay. Now, recently, oil prices are basically moving down on an annual basis, but speculators are getting more positive. But investors, the ones in the stock market, up here was the futures market. You can look at the valuation of oil stocks. This is a price to book ratio, book meaning equity on the balance sheet, price as traded in the market has been coming down. That means that investors are probably thinking oil prices are not moving up anytime soon. And the black line is just the profitability. So if oil prices are not moving up anytime soon, the profitability is not going to be going up. And you can see the price book ratio, the blue, and the return on equity, which is a function of oil prices, and among other things, they're both moving down right now. The last slide here, and then I'll summarize, and then we'll take Q&A. Why does this matter to you? Well, first of all, how does oil impact you on a day-to-day basis? Top graph, I look at the change in oil prices, the black, versus the change in inflation. Now, this is all inflation, including food and energy. And you can see they're highly correlated. So if oil prices start going up, maybe because the dollar is going down or whatever is the case, inflation is going to be higher. And right now, we're running at an inflation rate above the Fed's target, okay? Now you say, well, I don't put much fuel into my car. It's not a big part of my paycheck. I don't care about oil prices. Well, do you care about food prices? You can see also oil prices movement tends to lead food prices by about 10 months. A lot of people forget about, why is this the case? It's not just transportation costs. Like if you move things out of the farm to wherever they're going to be, put into things that you can buy. It's transportation costs, and you need fuel for that transportation. It's not just the cost for planting and harvesting. So if oil prices go up, then the cost of farming goes up because the fuel for the tractors goes up. But it's also because higher oil prices means more acreage of our corn. More acreage of our farm is in corn to produce ethanol. Because if oil prices are higher, it makes more sense to basically plant corn for ethanol than it does for food products, other food products. So if there's more corn for ethanol, then there's less corn for animal feed, which means the cost of animal feed goes up, which the cost of meat goes up. If there's more acreage planted for ethanol because oil prices are high, that means there's less acreage planted for, I don't know, take your vegetable that you really like and insert it in that blank line. And so if there's less acreage for that favorite item of yours, the price is going to go up. If I could have a wish, I don't want to upset any farmers out there, but ethanol is actually the dirty fuel. In order to plant corn for ethanol, we have to have fertilizer. And by the way, fertilizer is oil-based as well. We have to plant and harvest that corn, which means there may be more pollution. It has worse fuel economy for your car if you use ethanol, which is worse for the cars, which means cars run out quicker. Cars need to use more gas. If cars run out quicker, then what happens to your pocketbook? You have higher, basically have to replace the car more often. You're going to have to buy a car, which is made out of steel and aluminum and plastics. So the price of the plastics and aluminum and steel are going to go up. And frankly, your debt's going to go up if you buy a car with debt, which means your interest rates are going up. So it's, again, this is a difficult policy to stomach. And if there is these bad things, why do we have it? Well, Iowa votes first in elections, and I have a feeling that politicians would fear getting rid of that policy. Now, if I would get rid of that policy, I would say you need to support the farmers. I have a farmer that's a really good friend of mine. My mother's family was all farmers, so I think it's good to support the farmers, but I'd rather give them an extra handout than have them, plant corn for ethanol. All right, now, final thing, wrapping up with the dollar. The dollar is also inflationary in an inverted way. So the blue line here is the change in the dollar, and the red line is inflation. So when the blue line is, so it's inverted, and it's over here. So when the blue line is going up, what happens to inflation? It goes down, because when the blue line goes up, the dollar is stronger, it makes our imports cheaper, okay? And when the blue line's going up, which means the dollar is weaker, it makes us have higher inflation. So let's go back to the very beginning slides. We said, maybe some politicians don't like the strong dollar. Well, if you have a weaker dollar, you're going to have more inflation. You're going to have more inflation because oil prices are going to be higher. You're going to have more inflation because all your import costs are higher. And if you have more inflation, the Fed may have to get more aggressive raising interest rates. If that slows the economy enough into a recession, that puts you into a recession. So the dollar is important. Trade is important. It's cyclical. In order to fix the trade, it's basically a complex problem. Commodities are important. So I now open it up to questions. And don't forget, my next webinar, I'll be looking at asset rotations over the cycle. But I'm happy to take some questions from you right now. We'll do this for about maybe 10 minutes or so. So let me look at the chat. So there's a great question here. How do we determine the correct direction of causality in financial markets when there could be explanations for either argument? That's a hard one. You can get an idea of sentiment by looking at financial market prices. Remember how I just looked at futures for both oil and for commodities? So you can get an idea what the traders are doing. You can also get an idea. There's lots of various surveys, University of Michigan, expectations of inflation. So you can, there's a lot of different surveys out there where you can, survey the real consumers or businesses, and you can look at the financial markets because, financial markets are betting on the dollar inflation. So that's one thing. But ultimately, I come back to, on the dollar, generally over time, from an economics speaking, the most important thing was the relative growth of our economy versus others. So I'll leave that as my answer to that question. There's another question, a great question, and this one was also written in. Any thoughts on central bank digital currencies? Let's go all the way back to kind of my second slide here. So the US dollar is 60% of world reserves, transactions, debt issuance, etc. If people get upset with the US because of our tariffs or whatever is the case, or get worried about us because of Fed independence or rising government debt, could we shift to cryptocurrencies instead of using the dollar? That's a question because it's one I think about quite a bit, and it could happen, right? The problem with cryptocurrencies, at least with Bitcoin, is the transaction speed is extremely slow. So you really can't use it for transactions, okay? Right now, since it moves up and down so much, it's really not a store of value. I mean, if you're going to use something as a currency, you got to be able to use it for transactions, and it can't move around that much, so people can, be comfortable with it. My biggest problem, though, with having cryptos replacing the dollar or other currencies is because if that happened and that wasn't controlled by, let's say it wasn't controlled by central banks, then the central banks lose their ability to control interest rates in the economy and react when the economy is weak or when the economy is strong. It turns out it's possible that this question is, could there be central bank digital currencies? It's possible, but I don't think the current cryptocurrencies, if they're not backed on by central banks, they would, basically be ones that central banks would even allow to replace. If they became so popular, everybody was using them for transactions, and the central banks didn't control it, they'd probably outlaw it because they wouldn't be able to control interest rates, because they wouldn't be able to control monetary policy. If this became like central bank cryptocurrencies, one last comment, it won't be this investment vehicle that just goes up and up and up or down and down, down. It would have to be something that's very stable, okay? I have a question on what is gold and silver currently telling you about the US dollar? Well, gold has been on a tear up, and so has silver. It's possible that countries are a little concerned with using the dollar as a reserve currency, and gold is increasing its percent as a reserve, and that is actually happening. Now, why is that happening? Is it because they don't want to rely as much on the US? It's possible that is. If you think about, if the cryptocurrencies are not a solution to replace the dollar, what is? Well, maybe reserves in gold. Is Europe going to be the one that's going to replace the dollar? Well, Europe's kind of has some problems right now with wars and things like this. A reasonably slow economy over time versus the US. They have an aging population, so low GDP growth. So they've had some problems, although maybe this Ukraine conflict is resolved, and so people build up some faith there. Germany's going to enact basically an aggressive stimulus package, so possibly the euro grows in popularity. Is it going to be the British pound? Well, our economy is way bigger than the British, so probably not. Could it be the Chinese? Well, maybe, but China is pretty small, and do people really trust China that way? And again, Japan has the same problem as Europe with demographics and slow GDP growth, and also a small economy versus the US. So really the US at the moment seems like a best option. You could put it in gold, but again, it's not like you can take out a piece of gold and hand it to someone, like you can with the dollar. All right, let's go to the next one. Is there any effect on the national debt on the strength of the dollar? Okay. Well, if the dollar is strong, so think about it. If you, it's many parts, and I can't answer everything I would like to do in a little bit of time here. So it's a really great question. So if you invest in the US, so if you lend to the US, US government, 30%, I believe it's around 30% of the US borrowing is held by foreigners, okay? So foreigners lend to the US, let's say they make 4% interest rate on the 10-year bond over 10 years. But at the end of 10 years, the dollar goes up 10%. So they made 4% a year for 10 years, but then they made an extra 10%. So if the dollar is strong, if you think about it from an investor perspective, they have a little higher return by lending to the US government. So if that's the case, if they have a little extra return, if they think the dollar is going to be stable or rising, then the US is going to have more foreign lenders to us. If there's more foreign lenders to us, then our interest rate on the debt will be lower. And that will help out the national debt. Although if the interest rate is lower in the US, lower cost of capital because of the dollar's reserve status, that encourages our government not to solve our budget problems, which leads to higher amount of debt. So you got both things going for you. You can take your pick on which argument you want to do on that one, okay? I have time for maybe one more question. And if there's not, I do have one more that was written in. Okay, well, let me do this one. Actually, this is just a thought. So the main thing that is, remember, the dollar drivers are economic growth, inflation, and interest rates. I did inflation and interest rates as separate items, but it's really the real rate. If you're making money in the US, but your purchasing power is not being degraded, so inflation is lower, that would make the dollar truly go up. So you can combine these two into one factor. If you combine these two into one factor, they become somewhat pretty important relative to this economic growth factor. So it's real interest rate is interest rates minus the inflation component of interest rates. That really is what should be driving the dollar up and down over time. I loved your questions. I love the time I've had with you today. I hope you come to the next webinar, which is in February. And of course, I always say this, if you are hiring and looking to go to a great investment program, consider the investment management certificate program I direct. Wish you a wonderful day. Thanks for your time. Thank you for the nice comments.